Welcome to Beacon Point's Manager Insights webinar series. My name is Felix Lin, and I head up Beacon Point's Institutional Consulting Services Group. Today, our discussion will be a markets and strategy update featuring Josh Honeycutt of Mar Vista Investment Partners. Josh is a partner at Mar Vista and is responsible for portfolio management and research. As we've seen some greater volatility in the markets recently, as well as some heightened news about issues such as trade wars as an example, we thought it'd be timely to have Mar Vista review their current market environment, as well as possibly review some themes and factors that they believe are driving the markets today. More importantly, Josh will discuss how Mar Vista is navigating these markets on behalf of their clients. Thank you again, everyone, for joining us for this presentation. And with that, I'll hand it over to you, Josh.
Thank you, everyone, for joining me on the webcast today. My objective today is to align everyone's expectations with the goals of Mar Vista's investment process. And if I'm successful in doing so, we can create more value together as partners. I thought I'd start by first giving a brief overview of Mar Vista's investment framework, and then I'll provide an economic and equity market update. And I will end with a few comments on how our portfolio positioning relates to the current market environment. Our mission at Mar Vista is to grow and protect the purchasing power of our investors' capital at risk-adjusted rates that are superior to other passive equity investments. Our investment approach is focused on producing the best possible long-term results with minimal risk. And if you look at the chart that's in front of you, you can see in the first bar on the left-hand side that we've been able to outperform the S&P 500 and keep pace with the Russell 1000 growth over the current market cycle. I think it's worth also pointing out on the right-hand side of the chart that we've been able to achieve these results without exposing our clients to excess risk. This differentiated return pattern is an intended outcome of our investment philosophy and process. Now, how do we do it? It starts really with our investment beliefs. We know that stock prices follow business values over the long term. We also know that the only way for businesses to create value is by building durable competitive advantages. And finally, we also believe that capital preservation is equally important to capital appreciation and accumulating wealth. So with all this in mind, our investment process is deliberately designed to grow and protect our clients' capital. Philosophically, we summarize our investment approach by stating that we invest in wide moat businesses that compound cash flows by producing high returns on invested capital only when they trade at discount to intrinsic value. We implement our investment philosophy by taking a private capital approach to public investing. To qualify for our investable universe, we have three business requirements. First, the business must have an economic moat or some durable competitive advantage. Second, that same business must also be able to compound its intrinsic value over time. And third, the management teams that we partner with must be capable of optimizing returns on invested capital and maximizing intrinsic value growth for us as shareholders. Once we identify businesses that meet our investment criteria, we value them by calculating the present value of their future cash flows. After we complete all of our valuation work, we then use a multifactorial approach to building portfolios. This was a brief summary of how Mar Vista approaches the investment world and allocates capital, but hopefully this overview of our investment framework helps everyone understand how we allocate capital and what makes us unique. It should also provide some context on how the portfolio is positioned for the current market environment. This year and for the past 9 years, improving labor markets, strong corporate earnings growth, and low interest rates have powered equity markets higher. More specifically, the market's advance has been dominated by a select group of dearly valued technology companies. Looking at just this year alone, it's obvious that the technology sector has accounted for over 100% of the S&P 500's gains. We try to stay out of the economic forecasting game, but this doesn't mean that we don't have economic hunches. What it does mean is that we avoid making investment decisions that are dependent upon the economic views proving correct. If you look at the chart on the left-hand side, one observation is that the current economic cycle is the second longest on record. And judging by the chart on the right, maybe this can be partly explained by the fact that this economic recovery is the most anemic in modern history. To be honest, we have no idea when this economic cycle will end, but we do know that they are called cycles for a reason. They all have beginnings and ends. And based on some of the more recent economic data that we've reviewed, it appears to us that the U.S. economy is operating near its maximum potential. The longer this economic expansion continues, the more susceptible it's likely to become to exogenous shocks. Today, trade tensions, rising interest rates, the economic crisis in Turkey, any of these could easily derail the global economy. These geopolitical events and monetary policy decisions will play important roles in determining the direction of our economy over the next 6, 12, and 18 months. From a portfolio perspective, our investments are not overly exposed to any one of these current economic risks. Similar to the economic recovery, the stock market's also enjoyed one of the longest bull markets in history. As we enter the 10th year of stock market appreciation, it appears that caution and prudence have been replaced by euphoria and complacency. The fear of missing out has been almost too strong for most investors to overcome. And as you can see on this chart, as the market trades near all-time highs, the gains are increasingly coming from the largest and most expensive stocks. This type of market environment would be described as something that is extremely narrow. And we believe that this narrow market rally has been reinforced by the growth of passive investing. I'd like to point out that the last time the top 10 stocks represented this much of the S&P 500 was back in 2007 and also in 1999. Today's concentration is heavily weighted towards the popular FANG stocks, Facebook, Amazon, Apple, Netflix, and Google. And while these are all great businesses that dominate their competition, we own a few of these serial compounders. Our valuation discipline deters us from owning them to the same degree as some of the more popular benchmarks. As investors continue to crowd into the most popular momentum stocks, they're also shying away from more stable and predictable businesses. The chase for growth has left defensive areas of the market valued at all-time lows as a percentage of total market capitalization. In our opinion, defensive businesses have never been more out of favor with investors, and this trend is causing valuation-sensitive managers to underperform. Looking at a chart that measures current corporate debt levels, we also see another popular theme in the marketplace. Over the past 5 years, we've seen significant outperformance by highly levered balance sheets. To us, this is one of the most foolish ways to invest. Low quality rallies such as this one can cause short-term headwinds for investment philosophies like ours, but this trend tends to reverse itself as interest rates move higher. We've been through low quality rallies like this before, and from experience, we can tell you that they typically end with stiff financial penalties. When this low quality rally eventually sunsets, our financially sound investments should become more in favor. Successful investing requires always discipline and patience. Here at Mar Vista, we continue to invest on the basis of value and its relationship to price. We always avoid trying to time markets based on predictions regarding economies, markets, or psychology. And as you can see from our top 10 list provided here, we're finding better long-term investment opportunities in businesses that reside outside the two largest and best performing sectors of the market, which is consumer discretionary and technology. Our portfolios today are concentrated in companies with less representation and growth-oriented benchmarks, and this differentiation should be a significant tailwind to relative performance when equity prices eventually correct. The chart on the right here shows some of the extreme levels of concentration by the Russell 1000 growth in the technology and consumer discretionary sectors. We haven't seen levels of this concentration since the technology bubble of the late 1990s, and we all know how that bull market ended. It's important to remember that markets can change quickly. I think back to just this July, the equity market delivered its best month of performance since January, despite a swift correction in many of this year's best performing technology stocks. I think it was really unrealistic earnings expectations for companies like Netflix, Booking.com, Facebook suffered from 14 or anywhere from 10 to 15% corrections. Fortunately for us, our portfolio was largely unaffected by this volatility, which resulted in top decile performance for the month. The important point is not to focus on 1 month of performance. It's just to be mindful that to generate differentiated outcomes relative to the market over time, the portfolio has to be positioned differently. And today, from our valuation perspective, the areas that we're finding investment opportunities are not necessarily in the most dearly valued, over-owned, overcrowded technology investments. As long-term investors, we feel similar about our long-term performance as we do about the past 12 months. We're pleased here at Mar Vista to have delivered long-term double-digit returns and been able to do that with less risk. We prefer to always outperform all of our large-cap benchmarks across all timeframes, but we'll never violate our investment discipline in order to do so. It's in our clients' best interest to consistently follow our investment discipline. We think especially now that valuation levels are above average and fear is being overcome by greed. As I mentioned earlier, we don't know when growth at any price investing will come to an end, but we do know this cycle is extremely long in the tooth. And if the momentum markets continue, we'll probably fail to keep pace, though we should earn a reasonable return on our investor capital. We're perfectly comfortable with this scenario, and we hope that our clients are as well. We're confident that owning a portfolio of competitively advantaged businesses that generate superior returns over time leads to higher stock prices. This has been essential to Mar Vista's long-term investment success. That concludes my prepared remarks. I want to thank Beacon Point for hosting Mar Vista today and to thank all of their clients that have partnered with us.
Great. Thank you again, Josh, for your time and thoughts on the market. This was helpful for us in understanding what factors are driving the current market environment, as well as how Mar Vista is positioning the portfolio to navigate all of the risks as well as the opportunities in the market. Thank you to all of our clients listening in today. We appreciate your time and your relationship with us. Please do not hesitate to reach out to us if you have any additional questions on the market or specifically on Mar Vista's investment strategy. In addition, you can send questions directly to bpawebinar@beaconpoint.com. Thank you again, and we hope you can join us for our next Manager Insights webinar. Have a great day.